What I wish I knew at 18 instead of 28 is the difference between stocks and bonds. Understanding these two fundamental investment options can significantly impact your financial future. When I was younger, I often heard about the stock market and bonds, but I never really understood what they meant or how they could work for me. Let's dive deeper into what makes these two investment vehicles unique and how they can fit into your financial strategy. Stocks and bonds are two of the most common ways to invest your money, but they serve very different purposes. Stocks represent ownership in a company, while bonds are essentially loans you give to a company or government. Each has its own set of risks and rewards, and understanding these can help you make more informed investment decisions. Stocks are like owning a piece of a company. When you buy a stock, you purchase a small share of that company. This means you become a partial owner, and your fortunes are tied to the company's performance. If the company does well, the value of your stock increases, and you can make a profit by selling it at a higher price than you paid. This is why stocks are often seen as a way to grow your wealth over time. When the company does well, your stock's value goes up. This can be incredibly exciting, especially when you see your investment grow. However, it's important to remember that the stock market can be very volatile. Prices can fluctuate wildly based on a variety of factors, including company performance, economic conditions, and even investor sentiment. But if the company flops, so does your investment. This is the inherent risk of investing in stocks. If the company performs poorly or goes bankrupt, the value of your stock can plummet, and you could lose a significant portion of your investment. This is why it's crucial to do your research and diversify your portfolio to spread out your risk. Bonds, on the other hand, are like lending money to a company or the government. When you buy a bond, you are essentially giving a loan to the issuer in exchange for periodic interest payments and the return of the bond's face value when it matures. Bonds are considered a safer investment compared to stocks because they offer more predictable returns. They promise to pay you back with a little extra. This little extra is the interest you earn on the bond, which is usually paid out at regular intervals. The interest rate on bonds is typically fixed, meaning you know exactly how much you'll earn over the life of the bond. This makes bonds a more stable and predictable investment compared to stocks. Bonds are usually safer, but offer smaller returns compared to stocks. This is because the potential for growth is limited to the interest payments and the return of the bond's face value. While you won't see the same dramatic gains as you might with stocks, you also won't experience the same level of risk. This makes bonds an attractive option for conservative investors or those looking to preserve their capital. So, stocks equals higher risk, higher reward. This means that while you have the potential to earn significant returns, you also face the possibility of substantial losses. It's important to consider your risk tolerance and investment goals when deciding how much of your portfolio to allocate to stocks. Bonds equals lower risk, lower reward. This makes them a good option for those who are risk-averse or nearing retirement and looking for a more stable source of income. By including bonds in your portfolio, you can help balance out the volatility of stocks and create a more diversified investment strategy. Think of it like this: stocks are the roller coaster ride, thrilling but unpredictable. The stock market can offer exhilarating highs and devastating lows, much like a roller coaster. This can be exciting for some investors, but it can also be nerve-wracking, especially during periods of market turbulence. Stocks are the roller coaster ride, thrilling but unpredictable. The ups and downs of the stock market can be emotionally challenging, but they also offer the potential for significant rewards. If you can handle the volatility and have a long-term investment horizon, stocks can be a great way to build wealth. Bonds are the merry-go-round, steady and safe. Unlike the wild swings of the stock market, bonds provide a more predictable and stable investment experience. This can be comforting for investors who prefer a more conservative approach and want to avoid the stress of market fluctuations. Remember, it's all about balance. A well-diversified portfolio includes a mix of both stocks and bonds, allowing you to benefit from the growth potential of stocks while also enjoying the stability and income provided by bonds. This balance can help you achieve your financial goals while managing risk. Mix stocks and bonds to find the right fit for you. Your ideal investment mix will depend on your individual risk tolerance, investment goals, and time horizon. By carefully considering these factors, you can create a portfolio that aligns with your financial objectives and provides a comfortable balance of risk and reward. Start small, stay curious, and happy investing. It's never too early or too late to start investing. Begin with small amounts and gradually increase your investments as you become more comfortable and knowledgeable. Stay curious and continue to educate yourself about different investment options and strategies. And always keep learning to make informed decisions. The world of investing is constantly evolving, and staying informed is key to making smart investment choices. Read financial news, seek advice from trusted sources, and consider working with a financial advisor to help guide your investment decisions. Your future self will thank you for it. By taking the time to understand stocks and bonds and making informed investment decisions, you can build a solid financial foundation for your future. Your future self will be grateful for the effort you put in today to secure a more prosperous tomorrow.